Hi, I'm Doug Jones at Mortgage Magic and Buyers Realty. There's my NMLS number 28668 and my DRE number 00979517. And I'm a realtor and a mortgage broker. One of the things that my customers seem to have difficulty with a lot of times is just terms, and the assessed value term, appreciation, and depreciation. And I want to make a quick video to explain these. When you buy a house, the county assessor determines the assessed value. Now, 99 times out of 100, that assessed value is the same as the purchase price. And in California, we use 0.0125 as our factor to determine how much the taxes will be. So if a person buys a house for $1 million, we use 0.0125, it's 1.25%, and that taxes per year would be $12,500. Divided by 12, it's $1,042 per year. Now, let's go to appreciation. Appreciation means if it goes up. You buy the house for $1 million, and in 5 years, let's say 5 years, that house has done pretty well, and it's gone to $1.5 million, which we've seen in the last few years. It's very easy to do. So it goes to $1.5 million. Now, if you buy that house for $1.5 million, your tax base is going to be $1,562. Well, here's what's interesting. When you buy a house in California, we have Prop 13, you are limited to a 2% increase on your real estate taxes per year. Now, it can go up either to the amount of inflation or the 2%, whichever is less. So in this case, let's say that this house is 1.5. Well, in 5 years, this person here, the same house goes 1.5, is going to be paying $1,150 on their taxes. And this person here will be paying $1,562 because they bought it at a higher basis. So that's one good reason for going ahead and buying a house now, getting your financing in order now. It's always a good reason. And then depreciation. Now, depreciation is really interesting because let's imagine that you have a house and that you're renting it for $2,500 a month, and that your taxes and insurance and mortgage payment equal $2,500 a month. You're renting for $25,000, or your payments are $25,000. Are you losing money, making money? Well, in truth, you're actually making some money still because you get to depreciate that house, that value. Now, in depreciation, the same property, I put $600,000 because you cannot depreciate land. And the easiest way to determine what your factor is of the value of the house versus land is getting appraisal. That's always the easiest, and especially if you buy it as a rental, then the appraiser's already broken it down for you. But we get to depreciate over 27 and a half years. 27 and a half years over $600,000 is $21,818 per year, $1,818 per month. So when I'm getting back to my example, if you rent for $2,500, your mortgage, tax, and insurance are $2,500, you could still be making money because you are writing off another $1,818 per month. Now, usually people want more cash flow, but still realize that that is a big investment and a big benefit if you are becoming a landlord and renting your property out. So assessed value is determined at the time you buy the house. And in California, your taxes can only go up 2% per year. Appreciation is the amount that the value of the house has gone up over years, in this case $1.5 million, and you see that the taxes here are $1,562, whereas if you bought it 5 years ago, the same house, your taxes are now $1,150. And then depreciation, if you rent that house out, now we're assuming that you go here at this time, and because you can depreciate the house value at the time you make it a rental. But in this case, it becomes $1,818 a month. So I hope that helps. I know I went a little fast, but you got assessed value, appreciation, and depreciation all in the same breath. And give me a call if you have questions. I'm Doug Jones at Mortgage Magic.